Hello, children. Welcome back. Today, we're going to be talking about how banks create money. Yes, you heard me right. Banks create money out of thin air as if it was magic. The way that they do this is by making a loan. Let's say that I put $100 into my checking account, and the bank decides to loan out $50 from that $100. My $100 is still owed back to me. That $50 that went out to someone else is theirs now as well. That $50 is new money that did not exist until the bank made that loan. This is made possible because of fractional reserve banking. This is the way our banking system works. The bank only has to hold on to a small portion or a fraction of the money that is in our checking accounts or demand deposit accounts. That fraction is set by the Federal Reserve, our central bank, which I taught you about yesterday. All right, we look at how this happens by using, or we can figure this out by using a bank balance sheet. There are two sides of a bank balance sheet. There are assets and liabilities. Assets are things that a bank owns that are worth money and are going to earn them money. So like loans that they've given out. Liabilities are things that a bank owes back to someone else. So like demand deposits, or what's also called a checking account. So the most important parts: your demand deposits, the money that's in a checking account in commercial banks; your required reserves, that's the percent that the Fed tells banks they have to hold on to by law; the excess reserves, anything above the required reserve that the bank is actually allowed to loan out. All right, let me show you how this works real quick. So right here, first thing I'm going to do is look at the assets and liabilities. I see that our demand deposits or checking account is $100,000. There are $10,000 in our required reserves right now. $10,000 is 10% of $100,000. So I know that right now, the reserve requirement ratio on this bank is 10%. Our excess reserves is $5,000, and loans that we've made out is $85,000. We are going to ignore this money for right now because these are loans. This money is gone. We still have $5,000 that this bank can loan out to an individual. All right, let's keep going and look. That money that gets loaned out is going to go out into the economy, and people are going to be able to put that money back in the bank. So that money isn't going to get just loaned out once. It could get loaned out multiple times. So let's say right now, I'm going to give you an example. Let's say right now the reserve requirement ratio is 10%. I've deposited $1,000 in the bank. The bank must hold on to 10% of that, which is $100. That means that they have excess reserves of $900. They decide to loan that out to Bob. Bob is going to either spend that or put that in his own bank account. So that $900 is going to end up back in a bank account one way or another, at least some of it. So if he puts $900 in his bank account, the bank now has to hold on to $90, and they can loan out $810 to Jill. Jill puts that $810 back in her bank account. So far, that initial deposit of $1,000 caused the creation of another another $1,710. Bob's $900 loan plus Jill's $810 loan. So because we don't want to walk through these steps every time we talk about how much money gets created, we can use the reserve requirement ratio to get a money multiplier. This works much the same way that the spending and tax multiplier that I taught you last 6 weeks works. So the money multiplier, to get that, it's going to be 1 divided by the reserve requirement ratio. So right now that would be 1 over 0.1, and that would come out to 10. So our money multiplier is 10, and if the bank loans out $900, the maximum amount of money that can be created by that initial $1,000 deposit in the bank is 900 times 10, $9,000. If we look back here, if we loan out this $5,000 and our reserve requirement ratio is 10 right now, 1 over 0.1 again, that comes out to a money multiplier of 10. 5,000 times 10 is $50,000.